Well, like Mark Matthew joins us, let's connect with him. Let's take our conversation forward. Mark, good morning. Always a pleasure to have you back. Mark, post the Fed cut, the world has stabilized, which is financial markets are okay, crude is bouncing back, and the yields, in a sense, are looking settled. Do you think, from a market standpoint, the Fed event is over? It's time to move on, look at the next data, which is the US jobs data or something else?
It is a busy week for data. We do have the PC inflation coming out, a revision to GDP, and the developed market purchasing managers indices will all be coming out this week. So the market will certainly pay attention to any outliers there. But to me, the biggest problem is that the expectation for rate cuts is too big in the market. We can see futures are pricing in a 40% chance of a 50 basis point cut in November, which I just don't think is necessary or realistic. So the potential for disappointment is now higher than the potential for a pleasant surprise, in my opinion. And I'll add lastly that increasingly the experts are saying Kamala Harris will win the election in November. Even Nate Silver, who had been putting Trump in the lead in the electoral polls, now has it as a toss-up. So that could add a little uncertainty as well, because I think there has been an expectation that Trump would be in the White House again, and that is certainly more pro-market, pro-business than Vice President Harris being in the White House.
The markets have done well even when Democrats have been, in a sense, controlling the White House. So if there is no change, isn't that great good news?
It's not really bad news per se. It's just that the market was looking forward to a lot more or a lot of deregulation under Donald Trump, an extension of his tax cuts. With Kamala Harris, you would see more regulation. Actually, if you listen to her, you could even see a lot more taxes, things like taxes on unrealized capital gains. I doubt she'll be able to get those through, but that's what she's talking about. And those are definitely not market-friendly things.
Sure. So, Mark, what kind of a reaction, assuming both the circumstances and situation, if it's a Kamala Harris win to the White House or a Trump, what are we looking at in terms of a market scenario? Basis, the point that you were making, that it may not be as much of a cut in the remainder of the year as the markets are anticipating right now from the Fed.
Trump would be inflationary, probably, and so there would be less of a interest rate normalization. The Federal Reserve might not be able to cut interest rates as much. If you look back when he was elected the last time, high yield bonds did very well and stocks did very well because his policies, as I said, were pro-business and pro-markets. Under Kamala Harris, we would probably have a continuation of rate cuts, but as I said, it would generally be an administration that would be less favorable for the market. At least that's what it looks like on the surface. Of course, Congress is very important, and the likelihood of the Democrats winning both chambers of Congress is quite low. So even if she's in the White House, in the end, I don't think a lot of the really, what I would say, progressive socialist stuff, whatever you want to call it, that she's talking about, she'd be able to do.
Right, Mark, let's get in a sense as to what you're looking at back home by way of the fund flow situation. Coincidentally, we just had the highest FII buying spree since February of 2021 on Friday's trading day. But that aside, how are you reading into liquidity in India?
Well, more broadly, if I could answer that question on Asia, Asia is doing very well, the currencies and the markets. India is doing nicely this month in dollars. I think the Nifty's up about 2.5%. But if you look at Southeast Asia, Thailand is up over 10%. The Philippines is up 8%. Singapore is up about 8% as well. Even the Hong Kong stock market is up about 2.5%. So I sense money is flowing out to Asia. And if you get a situation where the US GDP is kind of slowing down and they're cutting interest rates and you have a weak dollar, but it's not an outright recession. And the S&P doesn't go up as much as it has done over the last couple of years. That's normally a situation that's very good for Asia. So I am starting to feel like the next 2 or 3 years could be very good for Asia. Now, where India ranks in that is harder to say because it already has had 2 very good years, whereas these other countries that I mentioned earlier, they haven't. So I would think if I was a global fund manager, my bias would be to the laggards within Asia rather than India.
Mark, so in the second half of this year, apart from US election, what else could be at play? What do you think would be the playbook? Because liquidity is going to be abundant. Inflation for the moment has taken a backseat. Fears of a hard landing, they've taken a backseat. So it's more like a Goldilocks scenario now.
It is, although to come back to what I said at the beginning, my concern is the market is too aggressive on interest rate cuts and the trajectory will not be as big as the market is currently expecting. The other thing is that the third quarter earnings season will start in 3 weeks and the expectations for earnings in the third quarter have come down quite dramatically. From 9%, if memory serves me right, about a month ago to just around 4.5% now. That seems to be, the cuts in consensus forecasts seem to have been quite broad across the sectors. So it'll also be interesting to see when we get the guidance from S&P 500 companies, will they be indicating that there's any cause for concern? I don't think so, actually. I mean, if you look at the consensus forecast for the fourth quarter and then this first and second quarter of next year, they bounce back up to 10%. But nevertheless, that sharp downward revision in third quarter consensus earnings forecasts is something that needs to be explained. Why is it that all of a sudden analysts have taken their forecasts for the third quarter down so much?
Mark, so why is the market across the board moving in a synchronized manner? Gold is supposed to do well when there is fear of inflation. Bitcoin is supposed to do well when there is problem in the world, but gold and Bitcoin are moving together. Equities are supposed to do well when there is growth in the world. And bonds are supposed to do well when there is slowdown in the world. It's just so nice. Nobody's complaining. Too good to be true, isn't it?
Yeah. Well, I suppose that among those, a few have got to be right and a few have got to be wrong. I think you could explain each one, really. I mean, falling interest rates is good for bonds, and it is good for stocks as well. And we're not looking at a recession next year. Recession would imply that treasuries do very well, but we're just looking for, I think, still slightly under 2% GDP growth in the United States. And then earnings growth, as I said, in the third quarter does come down to the mid-single digits, but then bounces back to about 10% in the next 3 quarters. And gold and Bitcoin, I guess, are going up, because the dollar is going down. So they all can be explained in a way. But I know what you're saying. It does seem a bit too good to be true.
Yes, indeed it does. So Mark, when you talk about India, I mean, while you just flagged off your views for Asia equities, but given the valuation concerns surely, and in a large pocket right now, it's getting a little difficult to find out anything that's undervalued here in India. Sectorally, what do you think is going to do well? We've seen banks make quite a comeback, especially the large private banks, which have been, lagging the rest of the market for quite some time now. Is that the space to be bullish on, and also because of the high FI participation?
I do think so. They are not expensive. They have lagged for no particular reason. The fundamentals look very good for the private banks. But as you know, with the exception of ICICI, they have not been good performers. So yes, I think that's a place to be. I also think that the move up in IT is interesting, not really based on any news, but clearly a signal of some kind of rotation, as is the case for consumer durables and staples, which I guess you could explain a little more by some green shoots in the rural sector of India. But anyway, what I would say is that the market is expensive. I think that in the next few months, it'll probably move in about a plus or minus 5% band. And we will get within that big rotation. My sense is the rotation should be into, as I said earlier, IT, private banks, consumer durables and staples, those kind of things that have lagged. And then PSUs, there's been so much good news imbued in them that any miss on earnings, I think would be matched by underperformance. So that's how I see it over the next few months.
Okay, and just in particular, when we were to talk about the earnings, you believe that any earnings disappointment could not be taken well? Are there any particular pockets that you expect the earnings disappointment to be more evident than the rest?
No, not off the top of my head. I'm sorry, but that's where the risk is in the PSUs.
All right, fair enough. Thank you for joining in, Mark. It's good to have you on board, getting your take on topics ranging from the US election to fund flows to where it is that you're expecting momentum when it comes to the Asia and the Indian market outlook.